Our technical session on class-by-class analysis of Finance Bill 2021. May I request third technical session speaker, CA PVSS Prasad, come on to the dais. CA Bildi Sridhar sir to present a bouquet to the speaker of the session. Speaker of the third technical session. Mr. PVSS Prasad is a practicing chartered accountant and an information system auditor and is a partner of Prasad and Prasad Chartered Accountants, Hyderabad since 1986. He is the past chairman of Hyderabad branch of Institute of Chartered Accountants of India. He is the past president of the AP Tax Bar Association and past chairman of International Physical Association Hyderabad subchapter. He co-authored a book titled International Taxation, a basic study published by Book Corporation, Kolkata. He was appointed as one of the branch reporters of International Fiscal Association Congress 2010 that was held at Rome, Italy on the subject Tax Treaties and Tax Avoidance, Application of Anti-Avoidance Provisions. He was chairman of All India Federation of Tax Practitioners, South Zone for the term 2010-2011. He was co-opted member of Committee on International Taxation of the Institute of Chartered Accountants of India for the year 2016-17. He was invited to speak at IFA Asia and Africa Congress held in Mauritius in May 2012, May 2014, May 2016. He was invited as a panelist at Asia Pacific Regional Tax Conference 2016 held in Seoul, South Korea in May 2016. He is a regular faculty for diploma course on international taxation of ICAI. This is the pre-profile about today's speaker, Mr. PVSS Prasad sir. Now, hand over to the Prasad sir.
Chairman of Hyderabad branch, Mr. Pankaj Trivedi, the other office bearers, and my good friends today. It's really a very eventful day. We could meet our beloved president and heard his message. And we're all looking at 2021 to be in a better shape, limping back to normalcy. And the very conducting of this physical seminar itself is an indication of trying to get back to normalcy and not the new normalcy. Anyhow, be that as it may, let us quickly get into the budget proposals, and I would like to run through in a little bit speedier manner before you get hungry and you will have to move to the lunch table. Anyhow, this budget is a very, very typical budget by itself. When we heard the Honorable Finance Minister's speech, we thought there must be very few direct tax proposals, except those that were mentioned by the Honorable Minister in this speech. But as we run through the finance bill and looking at the proposals that have been moved, there are some far-reaching implications with respect to the proposals, more on the procedural front, and some are really at the mechanism, the very assessment mechanism or the reassessment mechanism is sought to be totally revamped, and there are certain tinkerings which could have been avoided, which were done, and I always look at these tinkerings are not the brainchild of the minister, definitely, because this is all the background play of our great bureaucrats. And let us quickly run into the proposals and see what has been proposed and what will become law if it is passed in the Parliament. Exemption for leave travel concession is proposed in view of the pandemic, because in the pandemic it is obvious that no one has gone out for any travel, holiday travel and all that. So whatever that is paid by the employer in lieu of such travel allowance, leave travel allowance, would also be exempt provided it meets some conditions. And the conditions go in such a way that the specified period means it is 12th October 2020 to 31st March 21. I am told that some free coupons scheme has been launched, by most of the employers on the basis of directions given by the central government. And in this, the maximum allowance, this cash allowance that may be availed by an employee would be 36,000 or 1/3 of the specified expenditure, whichever is less. And for this purpose, you need to spend and obtain certificate from the vendors of the goods and services, and who must give a valid tax invoice under GST. And if we calculate, almost it would come to around 12,000 and odd GST you have to spend to avail this cash allowance concession of 36,000. And this is meant only for this year and not to be continued. This is because of the peculiar situation we have encountered, and this is applicable only to 21-22 assessment year and not further. And affordable housing has been the most the promoted activity, and by the government, and also in view of severe hardship faced by the migrant workers, even government has, the Ministry of Urban Affairs has come out with a action plan of affordable rental housing projects also to accommodate these migrant workers wherever they go to do their work. So all this has been the offshoots of this pandemic, and this affordable housing project is already there in the form of 80 IBA, and whoever is doing this project as an SSE, as a business SSE, carrying out this project would be eligible to claim tax holiday of 100%. And for that, one of the conditions is the project should have been, should have been approved by the competent authority on or before 31st March 2021. And the approval date has been extended by 1 more year to facilitate such assessees obtaining approvals because of this pandemic and all that. There is 1 more year extension has been given, and there is a corresponding corresponding provision also, which will come in the later slides with respect to the SSE who is going to be a first time home buyer. As you all know, government has been promoting International Financial Services Center, that is the GIFT City in Gujarat, that is in Gandhinagar, in a big way to promote that center to be on par with some of the international financial centers like Hong Kong, and even it should meet the standards of London. That is the dream of the Honorable Prime Minister. And we have slew of tax incentives that have been showered even this year also, with respect to creating the right atmosphere for all the investors, the foreign investors, to come and invest and make use of this, a tax haven like city in Gujarat. And in fact, I am not going into that because for want of time. And then let us go into zero coupon bond is also an infrastructure debt bond, which is brought on par with the infrastructure capital company bonds and infrastructure capital funds. Zero coupon bonds also to be issued by infrastructure debt funds will enjoy the exemption from tax deductions and all that, because in these funds, whatever that has been subscribed, there would not be any payout in between, and only it would be redeemed at the end of the period with all the accretions. And cooperative bank can now get converted into a banking company, and the route has been made easy for them to, I mean, there are a lot of exemptions available, and the transition would happen very smoothly. And this is also public, disinvestment of public companies also is made easy with the facilitating provisions of demergers and tax exemptions. And as I mentioned, as a corresponding provision to the affordable housing project, whoever is a first time home buyer, we have a provision in the form of 80EEA of the Act, which gives an exemption, I mean a deduction of 1,50,000 rupees. To avail this benefit, one of the conditions is that the loan is to be sanctioned anywhere between 1st April 19 to 31st March 2021. And obviously, in line with what is the amendment that is brought into the affordable housing loan under 80 IBA, even here, the first time home buyer availing a loan up to 31st March 2022, that is one more year of extension is given, and this would be made available. But only unfortunate thing is, the property that would be purchased should not be more than 45 lakhs in value, which is very impractical. In this high inflation era of real estate, there is a representation made to make it at least 75 lakhs, at least in cities like Hyderabad and Chennai and other cities, but it's not done yet. Let us hope that something would be looked into on that count also. And coming to the startups, because as you know today, startups are in a big way in India. We need to be really proud of that, because there are many startups that are doing exceedingly well. If you look at their balance sheets, it would be losses and losses, but the valuations will be on a high side. And even Zomato and others are doing very well. We have Shopclues, we have so many other unicorns that are in shaping. And to promote the startup in a big way, we have 80 IAC provision, that's a tax holiday provision. As you know, last year we had some amendments which have made some facilitating or some, more liberalized modifications to meet the requirement of the startup industry. Now the startups turnover can be up to 100 crores as against 20 crores in the past, and they will avail a 100% tax holiday for a period of 3 years out of the first 10 years. Earlier it was 7 years, that has been made 10 years, and now the said benefit, one of the conditions is that the eligible startup is required to be incorporated on or after 1st April 2016, but before 1st April 2021. Even here we have one more year extension to facilitate new startups getting registered and putting themselves in place. It's proposed to amend these provisions of 80 IAC accordingly. And then we also have one more provision in the form of 54 GB. Suppose you have a residential house property and you sell that property, you would like to invest the entire net consideration in a startup. That is being given a lot of encouragement, and there is a tax incentive for that. Whatever capital gains that's being there on account of the sale of residential house would be exempt if the entire net consideration is going to be invested in the startup. But only one condition is the eligible startup is required to utilize this amount for purchase of new asset within 1 year from the date of subscription in equity shares by the SSE. Further, it has been provided that the benefit available only when the residential property is transferred on or before 31st March 2021. They could have extended this to wider number of assets. Suppose you have shares, you have long-term capital gains being derived on sale of shares because the stock market is booming like anything, or you have an open plot. Of course, the plot is covered here, a house or a plot of land they have mentioned. Any other long-term asset also should have been made an eligible asset, and capital gains on that should have been exempt if at all it's invested in the startup. But for the present, it is only the sale of house or a residential plot, the entire net consideration if is invested in the startup, and such sale can happen any time before 31st March 2022. 1 year extension is here. And this is coming to 43 CA. You all know 43 CA is almost like an identical provision what we have in 50C. 50C is the sale of land or building in the hands of any SSE, whereas 43CA is with respect to an SSE who is engaged in real estate activity, and one who is making developing apartments and other commercial complexes, and if he is making a sale, if the sale consideration is not in line with the circle valuation or what you call the guideline valuation coming from the state governments, respective state governments, then there also you have similar approach being adopted in line with the 50C provisions. Then the assessing officer can adopt the guideline valuation and accordingly calculate the taxable profit of the SSE, business SSE. There is a safe harbor of 10%, up to 10% difference between the guideline valuation. Suppose the rate at which you have sold the property is lesser by 10%, not beyond 10%, then it is allowed and it's ignored. That 10% safe harbor has been increased to 20% because of some crash in the real estate properties because of the pandemic. Correspondingly, whoever is buying the property, 56.210 is applicable there. You have a similar safe harbor of 10%. Suppose 56.210 talks about a person who receives any property which is lesser than the market value. In case of a buyer who is buying a residential apartment from a builder, and if there is a difference in value more than 10%, he is to be taxed in the past for that particular value which is over and above the 10% difference. The 10% safe harbor is now increased to 20%, which is good. And in fact, we have number of case laws that have come from the Mumbai Tribunal, and all these relevant case laws have been listed out for your ready reference. They all have been ruled in the context of such differences of valuation between the actual registration and the guideline valuation. And coming to the senior citizens, there is a proposal, if at all he is a resident of India and aged 75 years or above, and he receives only pension and also interest income, nothing more than that. And if he has all his investments in one bank, he has to specify one bank. That bank is going to calculate the tax liability and deduct the tax at source, which should suffice the compliance, and there is no requirement for the such senior citizen, super senior citizen, to file any tax return. That is what has been proposed in the form of 87A provision in the statute. And sovereign wealth fund, and I am not going to discuss this is a high-end issue, addressing mismatch of taxation of income from notified overseas retirement fund. This is a very interesting issue which is which is applicable in most of the cases where you have some of the clients who are into salaried class but working for multinational companies and who travel abroad frequently. Sometimes like companies like Infosys, Wipro would have sent them abroad, and they would have gone there for the employment for 1 or 2 years and they would have returned. When once a person is working in US, be it in an Indian company or a overseas company, he has to necessarily comply with some of the social security requirements of that country, especially a country like USA. And you also need to contribute to the retirement funds in a mandatory manner. So that retirement funds are called 401k, that is regulation 401k as per the US IRS, and whatever you invest in that mandatorily as per the rules they have there, it keeps accumulating along with accretions, yearly accretions, what you call interest accretion or whatever it is. That's not taxable on the basis of accrual, but it is only taxable at the end when the fund is withdrawn. But whereas in India, when this gentleman who has gone as an employee abroad, he would have come back after 1 or 2 years and he continues to work in India and he becomes a resident here. And what happens as per the Indian tax laws, any interest is taxed on the accrual basis, and there is a mismatch. Whatever that is getting accrued in the USA's retirement fund needs to be offered here for tax in India, because he being a resident, the global income is taxable here. But whereas the same income is not getting taxed there in US, because the tax rule there says it should be taxed only at the time of redemption, that is the maturity, and not before that. So there is a mismatch of the taxing event, which creates a practical problem in getting the tax credits. Because you pay tax now in India, again 3 years or 4 years down the line, when the fund gets redeemed, then you will pay again in the US, and there is no way you can reconcile these two and take the tax credit, and thereby it would amount to double taxation. To address this, there is a new provision that is being brought in the form of 89A. 89A has broadly given us the leeway that this type of mismatches would be taken care, and the countries would be notified, and there would be a facilitating provision to avoid the double taxation. We have to wait and look for the rules, which is a very, very welcome proposition. And the minimum alternate tax 115 JB, when you go to 115 JB, especially there are two items which are again connected with transfer pricing, that is advance pricing arrangement and secondary adjustments. As you know, in transfer pricing, you have a transaction happening with your associated enterprise outside India. Suppose $100 is earned by your parent company sitting in US from the end customer, and you are outsourced a work from your parent company for which you are paid, say, $30. I am only talking about the profit that is shared between the two, and $70 is kept with the US parent, because US parent takes all the risk, and it faces the end customers, and it faces all types of risks, whereas you being a captive service provider, you don't run any risk, you just get reimbursements along with markup, whatever you bill your parent. This is the most popular model we have. Suppose the transfer pricing officer is going to dispute the margin you have offered, say $30 is not 30, you should have reported at least $40 profit in this country, and then he makes an adjustment of $10 here. So whatever adjustment you make should correspondingly be reduced from the $70 what is offered by your parent in US. Otherwise it would result in economic double taxation. That means the same income getting taxed in two different hands, unlike the juridical double taxation what we have under the DTAA. Economic double taxation, the classic example is company shareholder dividend taxation. Company earns profits, pays taxes, and declares dividends, and dividends are again taxed in the hands of shareholders now very much from last year. So that is the economic double taxation. So the same thing happens in the context of transfer pricing adjustments. Suppose, and what you mean to say that $10 must be reduced there in US, otherwise it won't, it would be resulting in double taxation. For this mutual agreement procedure is there, the competent authorities, that is the Joint Secretary Foreign Tax Division of India, would sit along with the similar counterpart in the US and try to resolve this issue, and it would be reduced there. If at all, that means if at all you are agreeing for this adjustment of $10 and not disputing, you are under an obligation to bring that $10 back into India. You would have got only $30 with you as a margin, but this $10 because you have agreed and you have not disputed this addition, you will have to bring it back. If you do not bring it back, it would amount to secondary adjustment, and the tax office of the TPO can impute interest at the rate of 18% on that if you are not going to bring it back. We have a lot of issues coming under the Foreign Exchange Management Act, because the TP assessment happens down the line after 2 or 3 years, and you cannot bring this amount back in line with the regulations under FEMA. And addressing these issues, they have come with a quick solution. we would not ask you to bring it back if at all you are ready to pay an additional tax of 18% on that. So this is how it has been settled, but whenever you are ready to bring it back, then you credit your books, this relates to a past year profit. And that past year profit needs to be reduced from the current MAT working you do. So that is what is proposed under this. Whatever you agree under the secondary adjustment, that needs to be separated, that needs to be aligned with the respective year's profit of, book profit and not the current year's profit. In the same manner, even advance pricing arrangement is nothing but you are going for a conciliation in advance so that to avoid the dispute with transfer pricing officer. And you would say, I am offering 15% margin, I am ready to offer up to 17%, then let us come to an agreement. Government and the taxpayer would sign the agreement for 5 years to come, and there would not be any scrutiny or adjustments if you follow the entire ingredients of the agreement. Even in such a scenario, sometimes the agreement negotiation would go down the line for 1.5 years. The agreement would have become effective, say now it is 21, that would have become effective from 18 or 19, then you are under an obligation to revise your profits for the past years. In such a scenario also, the current year's book profit should not be impacted by such accretion which belongs to the earlier years. You need to make these, you are facilitated to make these adjustments to arrive at the correct book profit of the current year. And even in view of dividend becoming taxable in the hands of shareholder now, and dividends are also received by the foreign shareholders who are covered by the provisions of DTAA, Double Taxation Avoidance Agreement at a concessional rate. Some of the DTAs, the US has got 15% and it could be 10% in some other DTA and all that. In such a scenario, this dividend part of the amount should be removed from the book profit computation, because like other items like FTS and royalties, which are already there is a provision to remove them. Now even dividend is brought in line with the same. And this is again REIT, that is Real Estate Investment Trust and Business Trust. They are transparent entities and TDS should not happen in their hands, because ultimately the profits of this business trust are going to be taxed in the hands of beneficiaries. So no TDS should happen with respect to the payments that are going to be made to these business trusts. Real Estate Investment Trust is already a reality. Investment trusts are also a reality in India, and SEBI has already given its regulations on that. And rationalization of the provision concerning withholding on payments made to FIIs. Again, FIIs here, foreign institutional investors, whatever dividends they are going to get from the Indian companies, they are going to enjoy a concessional tax rate as per DTAA. Now 196D says that you will have to deduct tax at 20%, and in fact in Pilcom's case, Honorable Supreme Court held that this is a deduction mechanism that is happening under Chapter 17B. It should happen as per 196D at 20%. If at all your treaty provides for a concessional rate of 10%, you go for return filing and claim of refund, which is now obviated, now which has been avoided now successfully, and the FIAs are allowed to get taxed only at the concessional rate as per DTAA. Even the tax deduction would happen at that rate now. And coming to the tax audit provisions, as you know, last year to give a big boost to the digitalization of the transactions, if at all a business person under 44 AB, if he is able to maintain his affairs in a manner that payments and receipts should happen digitally to the extent of 95%, then the tax audit limit is not 1 crore, but it is 5 crores. That 5 crores has been further increased to 10 crores to give further boost to this digitalization. And advance tax installment for dividend income again, because as you know, dividends, unless they are declared, you do not know how much you are going to receive, and you can't what you say, imagine what amount you are going to get and you cannot compute your advance tax. Along with these items, capital gains, income in the nature of, the profits and gains where income arises or accrues for the first time, income in the nature of section of 115 BBDA. BBDA is with reference to last year when dividend is exempt in the hands of shareholders, but there was a provision that was brought in 2 years, 3 years back, that beyond 10 lakhs, that is high dividend earners have to pay 10%. That now it has gone because the entire dividend is taxable now. So the dividend income per se, not the deemed dividend under 222E, but the dividend per se would be out in the computation of 234C interest in the assessments. And 1023C, there are two provisions we have with respect to hospitals and educational institutions. We have exemption provisions in the form of 1023C, 3AD and 3AE. Both there the condition is the gross receipt should not have crossed 1 crore. That 1 crore limit is being raised to 5 crores now with effect from 22-23 assessment year, that is from the financial year 21-22. 1023C registrations, as you know, happen before the Chief Commissioner, unlike 12-year registration which happened with the Director of Exemptions. Extending the due date for filing return of income in some cases. This is all with reference to this Portuguese Civil Code. They have brought, they proposed an amendment to extend the filing dates of the partners in line with the tax audit report and in line with the transfer pricing report. To file the belated return and revise the original return, the time limits have been reduced by 3 months. It has come down to 9 months. Earlier we used to have 12 months from the end of the assessment year for revision or for filing the belated return. That time limit has been brought down by 3 months, that we need to note. And coming to the defective returns 139(9), there are a host of reasons which can make the return invalid. And as you know, the assessing officer would issue a notice asking you to rectify the defect within a particular period. Generally 15 days time or maximum 30 days time is given. If at all you are not going to rectify, the return becomes non-est. It is deemed to have been never filed by you. So in some genuine cases, this hardship is creating a lot of problem, and that is the reason the government has come out with some facilitating provision to exempt some of the categories which they are going to prescribe. For them, such returns would not become invalid or non-est. We need to wait for the rules to be prescribed. And 36(1)(7)(a). 36(1)(5)(a), and section 43B, this is with reference to the Provident Fund contribution, employees' contribution to various funds, welfare funds. Employees' contribution being utilized by employer for longer time without depositing the same as per the deadline dates under the respective fund legislations, not under the due date given under the income tax law. Employer's contribution is fine, but employee's contribution is not your money. It is the money of the employee you are utilizing for your business purposes and trying to deposit that late. So that is always under dispute, and there are a number of judgments that have been rendered in favor of the assessee stating that even such employee's contribution can be deposited any time before filing the tax return on par with the employer's contribution. But to undo this issue, and now it's made clear that 43B provisions would not cover employee's contribution. It is only employer's contribution that would get covered. So employee's contribution should always be paid on or before the deadline date as prescribed by the respective fund legislations. Okay, so it is taken out of 43B's purview, and that would become your income. Already it becomes income. If at all, unless it is paid, it becomes an income. Once you pay, you get the deduction. If you are not paying on time, you will lose the deduction. And these are all the case laws which are given for your ready reference, which case laws that have confirmed, case laws that have been overruled. Overruled means those are all the case laws which are ruled in favor of the SSC in the past, holding a view that employees' contribution can also be paid on or before the return filing due date, which is no more a law now because an amendment is going to come. And 245 MA, this is a new proposition, Dispute Resolution Committee. See, now there has been a very evident action coming from the government to reduce the disputes, tax disputes. In fact, even in tribunal, up to 50 lakhs tax disputes, all appeals filed by the department have been withdrawn on the basis of circular given by the government. There is a lot of effort which is very evident from the government to reduce the tax litigation. So, in line with that policy, 245 MA is a new provision to address categories of taxpayers who are having income up to 50 lakh rupees, not beyond that. 50 lakh or less, that means all average taxpayers are going to get covered. And if there is an aggregate disputed amount is 10 lakh rupees or so, the SC would have an option to opt for or not opt for the dispute resolution through DRC. We already have a dispute resolution panel, DRP, for the transfer pricing adjustments and for the adjustments happening in the hands of a foreign company. Now we have a DRC. The SSC shall not be eligible to opt for the above scheme if at all the specified order is based on a search initiated under 132. That means if the SSC is covered by a search operation or by a survey operation or by any issue relating to double taxation avoidance agreement, obviously he would not be covered. And then if there is any detention, prosecution or conviction under various laws as specified in the proposed section, if at all these conditions exist, then such SSC would not be eligible to claim this dispute resolution route as being proposed now. The DRC shall have the powers to reduce or waive any penalty imposable under this Act or grant immunity from prosecution for any offence under this Act in case of a person whose dispute is resolved under this provision. And government is going to bring out an official gazette. As of now, the memorandum explaining the provisions did not give any hint who are going to sit in this dispute resolution committee. Obviously, even DRP, as you know, DRP is one of the biggest mockeries we have seen under the international tax and the transfer pricing. DRP has become a reality some 10 years back, and now we have 3 dedicated commissioners sitting in Bangalore, taking care of entire South. And this has become a mockery because the DRP, the original intention was extremely good. See, 3 commissioners sitting in judgment, it is not an appellate process, but they give directions, which directions are binding on the transfer pricing officer or the AO. They don't have a right to appeal. But if their directions are not giving the required relief for the taxpayer can always go before the tribunal, because we will directly go before the DRP is a parallel mechanism along with the CIT appeals. And the beauty with DRP is the demand is not crystallized, it's only a draft order that is passed by the AO on the basis of the TPO's order or on the basis of any adjustment being proposed for a foreign company. So the draft order has to be issued by the AO. Within 30 days, you can take the route of DRP and make objections stating that these are the these are the adjustments which we are disputing on the basis of technical points what you give. Then 9 months time is there. This is a time bound process. 9 months, within 9 months the directions have to be issued by DRP, and it's a passport to go to tribunal. Because DRP is not giving any relief, 99.9% they will not give any relief, because department doesn't have a right to appeal. If at all the directions, if the department is aggrieved, the assessing officer is aggrieved, he has no right. And obviously it is your own commissioners who are sitting on the panel and they direct that your adjustment is wrong. Why should you have any right of appeal? Because they don't have any right of appeal, they are simply endorsing what what nonsense TPO is doing. So that way DRP has become biggest mockery in the country today. That's what I openly tell the DRP commissioners when I go to Bangalore. sir, your function is highly unproductive. In a lighter vein, because it's of no use, 3 commissioners sitting, not 1 commissioner, 3 commissioners sitting, they don't give relief to a deserving case. They openly admit that this is a case you have to get relief. Then, sorry Prasad, we can't give because there is no right of appeal for the department. Even DRCs would be no better than that. I don't know, unless you give independent powers to these panels, there is no use, because they would be controlled by the chief commissioners, principal chief commissioners, and the targets and all this. They would not help in any way any taxpayer, but let us hope for the best. We always live on the hope. And then advance ruling. Advance ruling is one of the award objectives to resolve disputes in advance of a non-resident, to start with way back in 2003. When 2003 this legislation has come, everyone was so happy that this AR would prove out to be a real, because it is binding on the department. Unless you have some perversity, on perversity you can go to the High Court, to the Supreme Court originally. But these ARs are to be manned by a retired Supreme Court judge, and a vice chairman can be a retired High Court judge. The panel is very good, a very independent panel, not the department commissioners. 1 revenue member would be there, 1 judicial member would be there. But unfortunately, those posts of the chairman were always vacant. Hardly we had 1 Justice Ranganathan, the first chairman of AR, who did an excellent job for about 3-4 years. After that, there were no takers. And we also had Justice Arjit Pasayat, retired Supreme Court judge, who has rendered some very excellent rulings, and he is now part of the special investigation team along with Justice Shah. So this particular panel, though it has this particular authority for advance ruling, did not really take off in the way it was expected. So the government, that is true, many cases are pending for a long time. Against AR, we can, only if there is a perversity, we can go to the Supreme Court, and Supreme Court has given that specific jurisdiction to the Delhi High Court. So in this context, the government took a right decision to do away with AR. But the right decision is not really followed by a right action, because in place of AR, government proposes to bring in a board for advance ruling, which again would be manned by 2 chief commissioners, rank of 2 chief commissioners. If at all a revenue officer is sitting for adjudication, a policeman trying to adjudicate a guilty, you can never get justice. That's for taken, you have to take it for granted. But only thing is, against this ruling, both the department and the SSC can go to the High Court. So unlike DRP, where there is no right of appeal to the department, here the right of appeal to the department is there. Either department or the SSC can go to the High Court. But High Court overloaded with so much of pendency, which looks only into the question of law. How far the factual issues can be canvassed before High Court is a big issue by itself. But anyhow, be that as it may, this is what is being proposed. This is called Board for Advance Ruling as of now, and this is going to come into effect from 1st April 2021. There is going to be a very at-length representation being made by the International Fiscal Association, also where I am Vice Chairman. International Fiscal Association is a focused body for international taxation. It's a body, it's an international body headquartered in Netherlands, and India branch is a very active branch. Originally started by Mr. Rangachari when he was chairman CBDT. As you know, Rangachari is a chartered accountant and also a revenue official, and who held the position of chairmanship in the CBDT. And then reopening of assessments under 147, there is a total revamp of the reassessment procedure. The search provisions are not touched. Search provisions are not touched, but the entire reassessment procedure has been revamped. 147 allows the assessing officer to assess or reassess or recompute any income escaping assessment for any assessment year. A notice is required to be issued, which can be issued only when there is a information. I am wrong. I am sorry, there is a mistake here. Only when there is a reason to believe. That is the present provision. So there is a mistake that has crept in here, because we have been working on this presentation from last 2-3 days, and there is some mistake here. and that is not information. The existing law says the assessing officer must have reason to believe that there is an escapement of income in the hands of the taxpayer. Now what is being proposed? They are doing away with the wording of reason to believe, and they are going to what is proposed is the following information shall be considered as information which suggests that the income chargeable to tax has escaped assessment. Now it is all information driven, because with the analytics in place, with a lot of technology available for the tax department, now they are very confident, and they have in fact, the tax collections have been extremely good even in the pandemic because of the technology. That is what is being claimed even by the CBDT chairman, Mr. Modi. So they are so confident with the technology, they are able to go, they are going to get the information in a seamless manner, and that is the reason they want to put the wording information in the place of reason to believe. And in the process, what they are trying to do, as you know, a lot of deeming fictions are being brought in to facilitate functioning of the assessing officer in a very smooth manner without being questioned by anyone. We have a lot of jurisprudence that has evolved in the context of reassessments. We have judgments like Kelvinator, we have judgments from the Supreme Court coming in, various judgments stating that you must record your reasons thoroughly, and the reason to believe must be really proved. And it can't be a second innings for you to meet your whims and fancies. That cannot be. You will not be given second innings just for the sake of it, just because you have issued a 147 notice. So all the jurisprudence, some part of it is being neutralized. Whether this would really stand the test of legal scrutiny, we need to look and wait and watch. Now what they say, this information, if at all, has been flagged in the case of SSC in accordance with the risk management strategy formulated by the board, or final objection raised by the CAG, that is the audit objection we keep getting. Revenue audit happens after the assessment is over. If at all there is any tangible objection which leads and which concludes that there is escapement of income, then you can be visited with a reassessment notice. 153A to 153C, that is the assessment, search assessments happening under this particular code, which has come in 2003 in place of block assessments, is going to be done away with. From 1/4/2021, you are not going to have any assessment, search assessments happening under that provision, and even search assessments must happen under regular 147, 148 process only. And assessments or reassessments or recomputation under 132 or requisition under 132 after 31/3/21 shall be under the new procedure of reassessment as explained under section 148A. There also there is a mistake. 148A is a new provision under 148. You can just note down, it's not 148A, 148. Two mistakes. What is 148A? Forget about the search assessment for a while. For search assessment, this particular provision is not going to be applicable. If at all, assessing officer would like to issue a reassessment notice in, say, a taxpayer X, what he needs to do, he needs to issue a notice to the SSC and say that he is proposing to issue a reassessment notice and call for his objections, giving out the facts on which he is trying to base, because it's all information driven. And if at all the objections raised by the taxpayer are not conceded, and with the approval of the principal commissioner, then he can issue a 147. He cannot issue a 147 just like that in the past. For that, he has to pass an order under 148A after hearing the SSC, his objections and all that. Then he will pass an order under the new provision 148A stating that on this basis I am going to issue a reassessment notice under 147. This 148A proceedings are not going to cover search matters. If there is a search that has happened, and there is one clarity that is missing, whether it would cover a survey matter or not is not clear, because at one point survey is getting covered and the other point it's not clear. We need to wait for the clarification. But I understand even survey would not get covered under 148A, survey or search. So the regular reassessments, you will have all this happening in advance. If you remember, even in the present law, you have a right to know the reasons why reassessment proceedings have been initiated. You can write to the assessing officer before surrendering to the reassessment jurisdiction. You can request him to give the reasons on the basis of which he has issued the reassessment notice. This is as per the Honorable Supreme Court judgment GK and Drive Shafts case. And assessing officer is bound to give the reasons before he gets into action. Otherwise, the entire proceedings will crumble. So that is what we have. And now probably to meet the ratio of the Supreme Court judgment, a process has been developed under 148A in advance, beforehand, by the assessing officer to conclude whether the reassessment action has to be initiated or not. One heartening thing is the 6 years period has been being brought down to 3 years reassessment. But don't be so happy just hearing at 3 years because there is a rider again. Time elapsed more than 3 years from the end of respective assessment year. Principal Chief Commissioner or Principal Director General can authorize AO to reopen provided there is an escapement of 50 lakhs or more. What is 50 lakhs today? 50 lakhs is nothing. Even the smallest trader, one quarter's turnover would be 50 lakhs. So there they can go up to 10 years. The 6 years is increased to 10 years. So that way I would see this not as a liberal provision, but it is the 6 years has become 10 years, and in very few cases the 3 years period is there. This is going to immediately come into effect. And 142 notice, that is 142(1), an assessing officer only can issue 142(1) to you, asking you to file your tax return if it is not filed. Now even the prescribed authority can also issue that notice. That is because it is now a faceless assessment provision. It's a faceless assessment, faceless penalty, faceless appeal. Provision for faceless proceedings before the Income Tax Appellate Tribunal. The faceless approach, though it is not tested, though it is not proved, and now the government is trying to jump and bring the faceless approach even in the tribunal, which is a highly retrograde step. It's a very highly retrograde step. In fact, Arvind Datar in one of his clippings has given an excellent, it's there in the YouTube, you can see. Arvind Datar and Mohan Parasaran both have commented that this is a most retrograde step. I would think that this is initiated by our great brains of the bureaucracy because they are so much cut up with the tribunal. In tribunal, their success rate is hardly 10%. 90%, because you are doing all nonsensical adjustments, nonsensical addition, 90% relief rightfully SSS are getting in the tribunal. So that 90% relief they are not able to bear, and now somehow they have brought in this faceless approach into the statute in the form of a proposal. Of course, it has not yet become a law, and all the leading advocates and the fraternity, judicial fraternity, the legal fraternity is opposing this, and even institute must really oppose in a big way, stating that the faceless approach cannot happen in judicial proceedings. You need to have an interaction with the judges. You need to present your case in a personal hearing. Of course, virtual hearings are happening because of the pandemic. I am also arguing every month 1 or 2 cases virtually. So that can continue depending on the gravity of the case. You might opt for a personal hearing. If it is a covered matter, if it's a small matter, you can argue virtually so that everyone's time and cost is saved. But faceless should not become the norm for ITAT. That is what is opposed very, very vociferously. Discontinuance of Income Tax Settlement Commission. Somehow government thought that the Settlement Commission has gone beyond its brief, and they are doing away with this, and interim board for settlement is going to come in that place, and all pending applications are going to be shifted to the interim board, and again this is going to be manned by 2 chief commissioner rank persons. It would be manned by 3 members, and the majority decision would prevail. That is what is being proposed now, and Income Tax Settlement Commission is a history now. And reduction of the time limit for completion of the assessment 153, even completion of assessment earlier it was 12 months, and now it is being reduced to 9 months from assessment year 21-22 onwards. And coming to the charitable institutions and trusts, you have an obligation to invest 85% of your surplus in furtherance of the objects of the trust. And whatever corpus donations you receive are not to be treated as income of the trust. And our taxpayers who are always, who have a lot of ingenuity, and the corpus donations are being applied in the prescribed application deposits, that is deposits and other things where you need to apply the 85%, and they are trying to take the credit under the 85% requirement. Again, when it is being repaid back to the corpus also, again they are taking a double deduction. In the same way, when you make application of funds into the prescribed format of investments by borrowing a loan, they are taking credit for complying with 85% requirement. Again, when the loan is being repaid, again they are taking. Now, you can't do that. You will have only one time deduction. If at all you borrow and make the investments required under section 11, only at the time of repayment of the loan, you will be eligible to claim the credit for this 85% coverage, not at the time when you borrow and invest. In the same way, when you fund the investments from the corpus, it is not to be allowed, no credit would be given to you. Only at the time when you replenish back to the corpus, then you will get the credit. That is what is proposed, and there is no carry forward. Suppose instead of 85% you have put 95%, you can't say that 10% what I have done last year would be carried forward for the next year. That's not available. And this is being brought immediately into effect, and this is the case law, this Medical Relief Society, and these two case laws that the tribunal has ruled exactly in line with the amendment that is being proposed now. And this ULIP, high premium ULIPs are under fire now, and suddenly the tax department realized that high salaried employee, I mean this clause 10, this is a ULIP is a, that is with reference to the Provident Fund. The ULIP is a high premium unit linked insurance policy. The entire redemption benefit is exempt under 1010D. And now they want to bring a cap on that and see that only 2,50,000 is allowed and not more than that. And this has come into effect immediately from 1st February 2021. So you will have only, suppose you have a bunch of ULIP policies, again you will have to pull out and say this particular amount of 2,50,000 alone is creditable, claimable as deduction, and only with reference to that you can take the tax advantage and not beyond that. And taxation of proceeds of high premium, this is coming into effect immediately. And slum sale under section 50B. Coming to the slum sale, it is an unwanted amendment, but it's more of a clarificatory amendment. If at all slum sale is happening, as you know, 50B talks about the slum sale, where slum sale is to mean the transfer of one or more undertakings as a result of sale for lump sum consideration without value being assigned to individual assets and liabilities in such cases. This has been interpreted by some courts that other means of transfer like exchange, relinquishment are excluded. Because in Bharat Bijli's case, Bombay High Court held that where slum sale is happening in a manner that compensates and the consideration is flowing in the form of shares, then they said this would not amount to slum sale. But that's with all due respects, that judgment is wrong. And to clarify, the slum sale can happen in any manner. It can happen in a cash payment manner, or it can happen in the form of exchange of shares and all that. So any mode you adopt for paying the consideration should not do away with the nature of the slum sale character as defined under 50B. And 45(4), And section 48, this is profits or gains arising from the transfer of a capital asset by way of distribution of capital asset on the dissolution of a firm or other association of persons or body of individual, otherwise shall be chargeable to tax as income of such firm. Or, as you know, 45(4) with respect to the partnership, when a partner is retiring, there is always a dicey issue because the wording used is otherwise. As far as the dissolution is concerned, if at all any immovable property is settled against the partner's capital account, definitely it would attract capital gains under 45(4). But the wording used is otherwise. There were arguments taken before the courts that this would not apply in case of retirement of a particular partner whose capital account is being settled by exchange of an asset of the firm. But there also now the clarity is brought in that 45(4), and there is a 45(4) is replaced and 45(4)(a) is also brought in, wherein it is proposed that even if your capital account is settled in cash, suppose your capital account, your credit is only 1 lakh, suppose you are given 5 lakhs, the 4 lakhs is going to be taxed. So let it be an immovable property or any other asset, movable asset also, if it is being settled. So the valuation, fair market value has to be taken and it would be taxed. And there are cases overruled, that means cases which are ruled in favor of the assessees in the past, stating that 45(4) would not apply and there is no capital gains tax. They are now overruled. Electroplast Engineers, Bombay High Court, and Karnataka High Court, Dynamic Enterprises, and Savitri Kadur, Bangalore Tribunal, in fact, has ruled the way it is being proposed now in the amendment. And specified person receiving any money, this is also 45(4)(a), other than immovable property, if at all the retired partner account is getting settled in cash or any other movable asset, then also you have that excess amount being taxed in the hands of the firm. Provisional attachment in fake invoice cases, this is 281(b) is not. Then coming quickly to equalization levy, another 10 minutes I am going to close, maximum 5 to 10 minutes. Equalization levy, again, if you have the patience, I can take 5 minutes on this because this is the most happening thing in the world now, the digital taxation. Digital taxation, this is a big debate happening in the world, how you are going to tax the transactions which are happening digitally, unlike in the past where physical presence was required. Now, Google-like companies, they don't require any physical presence and they earn billions of dollars from countries like India without any physical presence. You would have got Google India Private Limited in India, in Hyderabad, in Madhapur, that will do a different activity. But the main earnings happening in a seamless manner because they don't require any physical presence. The international tax rules of the past insist for physical presence so as to constitute a permanent establishment for taxation of a non-resident in India. That has utterly failed now because of the advancement of the technology. And this is not only in India, across the world, this is the biggest debate today. And US being the big brother, having 9 out of 11 techno giants in US is not willing to accept the new taxing rules because those companies are going to be impacted in a big way and US doesn't want to lose out on the taxes that need to be paid only in US and not elsewhere. So this is where US is putting its foot down and not cooperating, being a big brother in the OECD. That is become the big roadblock. In fact, when Donald Trump was there, he did not cooperate at all. Entire his team did not cooperate. They have given trade war warnings to France. When France has brought in the digital tax, France was slapped with so many tariffs in the trade agreements on so many products that are being imported from France. And now that is happening across with other countries, including India. India has brought in this equalization levy last year. As usual, our bureaucracy will put it in the last minute in the budget. In fact, this equalization levy, which was brought in 2016, was only with respect to the advertisements. To that extent, no one, because whoever, suppose a resident of India is availing an advertisement space in Google, cyberspace, in the website or whatever you may call technically, he has to pay Google, say $1,000 or $10,000, depending on the advertisement space he is going to avail. And on that, the person who is going to pay the Google has to deduct tax Obviously, Google with its bargaining capacity, it will just simply say, pay $10,000 and keep quiet. Then that extra amount of 6% was always paid by the resident payers who are availing that service. Now, equalization levy has been brought in a different manner. This is against the e-commerce supply of goods or services by an e-commerce operator. 2% he has to pay himself, though he is a non-resident. It is targeted at non-residents only, not residents. Like Amazon, Flipkart also, of course, Flipkart we do not know whether it's a resident or a non-resident, or Walmart, whoever it is, they will have to shell down this 2%. Again, this equalization levy is fraught with so many inconsistencies, and it is not part of the income tax law. It is not part of the DTA. It is beyond these two. So that whatever you pay under this equalization levy, you are not going to get tax credit in your resident country. So there is a big hue and cry, and as usual, US has started its trade investigation under 301 of the US Trade Act 1974, and they have issued a report on 6th of January this year, stating that this is highly discriminatory in nature. This is targeted at non-residents. 72% of the companies are US companies being put to hardship, and this levy is actionable. What actionable? What action they will take? They will put tariffs on all various exports we are going to do. So that is the mechanism they have. So they said it is actionable and they stopped there. And now India is responding. India is also very strongly responding, stating that the OECD action plan on digital taxation has not reached finality. There is no why there is no consensus? Because US itself is blocking the whole issue. They are not allowing any new tax rule to come. They are telling you go by the old rule. Old rule is a redundant rule. See, Google-like companies, they don't require physical presence. If there is no physical presence, there is no way you are going to tax. So this is what we are. These are the most happening times for international tax and digital taxation, especially the next 2 years are most happening times. And now on equalization levy, some clarifications are brought in, and these clarifications are widening the scope. In fact, the bureaucracy is always known for widening and complicating the whole issue. They are telling there is a grievance stating that suppose my hotel booking as a non-resident is done with a IP protocol I have in India, internet protocol I have in India. I am a non-resident. I booked a hotel in Hyderabad or Bombay, then that would come under equalization levy. Suppose I have booked a cab for my 1 week stay in India through a very professional cab service provider, that would come, because I have booked through online, it comes under equalization. See, it is supposed to cover only those goods or services get delivered through digital means. See, you are making a booking, but the service is happening physically, that should not get covered. That is what we wanted some clarity to come, but it is more complicated. They are now telling definition of e-commerce supply or service, online sale of goods shall include one or more of the following activities, not all. Acceptance of offer of sale, if that is done, that is good enough to treat it as a digital service to be covered by equalization levy. Placing the purchase order, acceptance of the purchase order, payment of consideration, supply of goods or provision of services partly or wholly. And again, this fifth item need not necessarily happen physically, need not necessarily happen through digital means. Even then, it becomes an online transaction to be covered by the equalization levy. And of course, from 1/4/2020, this has come into effect. 6%, 2% has to be paid, and corresponding exemption is given for that particular transaction from the income tax levy under the income tax law. So some clarifications are brought in, but these clarifications are expanding the scope of equalization. I would stop there because this is a subject where experts would discuss for days together. That is what is happening across the world now, including IFA forums. We have regular discussion on this. And goodwill is now going to be charged. Charged in the sense goodwill depreciation you cannot claim on goodwill. Smith Securities, Supreme Court held that goodwill is depreciable if at all you are making a lump sum consideration, which consideration is more than the value of the assets you are going to acquire, obviously that excess amount what you are going to pay would go and sit as goodwill in the balance sheet, and that goodwill needs to be depreciated. That is what Supreme Court has accepted almost in 2016 itself, and that is being undone. All the M&A deals, mergers and acquisition deals will have to be reworked because depreciation is not going to be allowed. Since 1998, this is treated as an intangible asset because the block system what we have in the assets, intangible, there is no specific mention of goodwill, but it is interpreted even goodwill is covered by the courts at the behest of the taxpayers arguing the cases in the courts. Now the goodwill is not depreciable, it's made very clear. If at all it is self-generated, the cost is going to be nil. Even though you purchase, that's not going to be depreciated. That means you pay a high price. Today, Zomato, being a food delivery app startup, the valuation is very high, but they are into losses. There are no assets, tangible assets in the balance sheet, but you will get excellent valuation, running into billions of dollars. Then how do you account that? It will all go and sit in the form of goodwill only. So that goodwill is not going to be depreciated anymore, and this is a far-reaching consequence where chambers of commerce are stoutly opposing. This is not in line with ease of doing the business. This is against the accounting principle also. And rationalization of the provision relating to the processing of the returned income and issuance of notice under 143(2). The processing of returns, 1 year period is reduced to 9 months, and issue of notice, they should issue a notice within 3 months from the end of the assessment. That's all. 6 months time is reduced to 3 months. That is good. And adjudicating authority under the Prohibition of Benami Property Act, we need not discuss now. And presumptive taxation of the profession, this 44 ADA. 44 ADA is akin to 44 AD, what we have for traders. 44 ADA covers professionals. You know, up to 50 lakhs earnings, receipts, offering 50% as presumptive income, you can do away with maintenance of books and there would not be any scrutiny and all that. In this, only individual HUF or partnership is covered, but not an LLP is covered. That we need to remember. Any client having an LLP, because the LLP Act itself prescribes maintenance of books, so it would not apply to LLP. LLP being a professional firm would not get covered by the 44 ADA. Vivad se Vishwas scheme is not going to cover income tax settlement commission cases which are pending or not getting covered by Vivad se Vishwas. That has been clarified. And liable to tax, purchase of goods liable to tax, this is again an international tax issue which I am not going to discuss. Liable to tax is being unnecessarily being defined. Supreme Court judgment 263 ATR Azadi Bachao Andolan's case, liability to tax is different from subject to tax. You may be liable to tax, but you being under SCZ, you are not subjected to tax. But even then you are a resident of this country. Even then you have to be counted as one who is liable to tax. Basically you are liable, but presently you are not subjected to tax because of a specific tax holiday mechanism. So that distinction has been well laid out by the Supreme Court. In Azadi Bachao Andolan's case, we have Green Emirates, we have plethora of cases, and liable to tax is a word used in Article 4 of the Model Convention to decide the residency of a non-resident. So here, for want of time, I am not going into that. I don't want to bore you because it's an extremely important concept under the international tax. I don't know what made them to bring a definition to this, because here they are giving a definition. Liable to tax meaning in relation to a person means that there is a liability of tax on that person under the law of any country, and will include a case where subsequent to imposition of such tax liability an exemption has been provided. That means he has to necessarily should have paid tax originally and got exemption later, then only he would be a resident covered by the concept of liability. That is wrong. See, I could be a trust who is always exempt from the beginning. See, GE Pension Trust case, argued before here, Nishit Desai has argued, in GE Pension Trust case, The India-US tax treaty has given a wording specifically for trusts. The wording is subject to tax. Unless they are subjected to tax in US, the trust is not a resident of US. Unlike other person, it is liable to tax. They need not be subjected to tax. If they are liable to tax, it is good enough. So this will create a problem for me that though I am really liable to tax, I am not getting covered by the definition because originally I should have paid some tax for some years and then got into the exemption framework, which is wrong. I don't know why they have incurred. Kamalesh Varshni was there yesterday in the panel. He is the Joint Secretary, Tax Policy. In the IFA, yesterday we had a panel discussion virtually, and he is telling liable to tax. Even I keep my comments reserved because it's a huge subject by itself. There is an amendment brought in, and he was trying to say that it's a clarification. There no clarification is required. Whenever a clarification is given, a lot of litigation will flow. 191 of the Act, tax surcharge in pursuance of declaration scheme IDS. IDS, they are facilitating some excess payments as refunds now without interest. That is the amendment. 194Q again is a very bad amendment. What they are telling, I don't know what is the logic behind that. If you are buying goods more than 50 lakhs, the buyer has got more than 10 crore turnover, then the buyer has to deduct 0.1% when he is making the payment to the seller of the goods. See, slowly you are bringing TDS into purchase and sale of goods also. So there is no end to this thirst. And this TDS become a big, one of the biggest nightmares now for the SSEs for compliance. And already you have a TCS provision which is there last year. The seller will deduct. That is TCS. That is also for 10 crore business person. And TDS again is 0.1%. Now they say if both are there on the same transaction, TDS will prevail, TCS won't be there. But that is not a solution. They are going on increasing the gamut of this TDS like anything, coming even to the sale and purchase of goods, which is never there in the TDS framework in the past. And this is, I think we have come to the end. It's the last slide. Higher rates for non-filers. You just see 206 AB of the Act would apply on any sum or income or amount paid or payable or credited by a person to a specified person. The proposed TDS rate is higher of twice the rate specified in the relevant provision, twice the rates in force, or 5%, whichever is higher. This section shall not apply where the tax is required to be deducted in section 192, that is for salaries, 192A, 194B, 194BB and all that. Section 206 CCA of the Act would apply on any sum or amount received by a person from a specified person. The proposed TCS rate in this section is higher than that is the TCS. And if the provision of section 206 AA and 206 is applicable to in addition to the provision of 206, the tax shall be deducted at higher of the two rates. Higher of the two rates must be deducted if there is a overlapping claims from two provisions. And the specified person is a person who has not filed the returns of income for 2 assessment years immediately before the previous year in which the tax is required to be deducted. In simple terms, without confusing you, if I am deducting tax, I should know about the tax returns filing status of the payee also. Will anybody tell? See, I will be kicked out if I am asking that. Who are you to ask me whether I have filed my tax returns or not? So, how do I know? I can ask his PAN. Okay, if PAN is not there, anyhow that 20% is there. Why you are bringing this meaningless? Correct. Correct. And they want more and more iterations in the software. Exactly. See, for non-filers, it is an obligation cast on the payer. Payer will take the PAN if it is a payment to a resident. Non-resident will let us not get into the non-residents now. See, I have a tendency to get into non-residents. It will take a lot of time. So, payer, in the resident payments, I can get only PAN. I can ask Ms. Mahendra Reddy to give his PAN. I can't ask whether you have filed your returns. He will kick me. Who are you to ask me? So, I should know if he has not filed 2 years tax returns, then I should double the tax deduction. If it is 5%, I have to make it 10%. If it is 10%, I have to make 20%. This is what is being proposed. I think this must be vociferously opposed because putting too much of a burden on the tax deductor. In fact, the tax deductor is doing a yeoman service to the government, and you are going on adding responsibilities and trying to fix him and trying to penalize him. This is not a fair play, and in fact this needs to be opposed vociferously. And Provident Fund is the last thing. Provident Fund, they have realized that high salaried taxpayers, they are putting a lot of amount in the recognized provident funds and employees provident funds, because that is a exempt, triple E status. They want to cut it down, and they have realized that people are investing 100 crores, 80 crores, I don't know, must be Ambani families who are having also a salaried income like MD, or I don't know, or Adanis, or stray cases you take and you try to penalize everyone. Only 2.5 lakhs is now allowed as a subscription into Provident Fund. Beyond that it is not, and it has a retrospective effect, because whatever you have invested in excess of 2.5 lakhs in the past year, interest being earned on that is going to be taxed now. Not only the deduction under for deduction from the present income, even interest earned is now going to suffer tax, and there would not be any tax exemption on that. This is what, friends, I thought I would bring before you today's afternoon. I know all of you are waiting for lunch and you are all hungry, and I am happy to be here after 1 year's real struggle of pandemic by all of us. And I really compliment Mr. Pankaj Trivedi and his team in organizing this event, and I'm so happy to be here this morning to share some of my thoughts on Finance Bill 2021 with respect to the direct tax proposals, and thanking you all for a very patient hearing. Thank you very much.
Meeting, sir. I sincerely thanks to CAPVS Prasad sir for his useful address and sharing knowledge on changes in direct tax in Finance Bill. I request Y. Tirupataya sir to present a memento to the Speaker PVSS Prasad sir.
Sincerely thanks to our President Audit Gupta sir and addressing us, along with Devaraj Reddy sir, and with the support of all 2 Central Council members, Dayaneva sir and Prasanna sir, and with the support of 3 Regional Council members, Chengal Reddy and Chinamastan Garu and Naresh sir. I thanks to all the Hyderabad branch staff and photo staff for smooth conducting of this program. I request everyone kindly join for lunch.